Hello everyone, welcome to ACCA P6 UK video lectures for the Finance Act 2017. Now we are going to look at when the company buys back its own shares. That is also part of the corporation tax, and that is our last topic in our corporation tax lectures. And so let's see, when the company buys back its own shares, what happens? For the corporation tax purposes, there are two treatments which are part of our syllabus. So whenever the company buys back its own shares, there would be one treatment which is called income approach. So I've written down here as well on the top, income approach. And this one on the top I've written down capital approach. So there are two approaches, one is income approach and other one is capital approach. So there are certain conditions for the capital approach. If them conditions does not apply, then in most of the cases income approach will apply. All right? Now say for example, if the income approach applies, then we will have to pay income tax and we will also have to pay capital gains tax. How would that work? So if income approach applies, then if the company is buying back its own shares, its own shares, so there will be income tax. So how would the income tax be calculated? So we'll take the sales proceeds. Sales proceeds would be the one the individual is selling the shares for, which would most likely be the market price. So take market price of the shares, so take that, less cost. So cost would be the original subscription price, so whatever the individual had paid for them shares originally when he bought it. So we'll deduct the original price, original cost out of that. So take market price less original cost. So whatever the net amount is, it will be considered as dividend for the income for the income approach. Right, so whenever the company is buying back its own shares, most of the time it will be considered that the company is paying the dividend, whatever is in excess of what the original subscription price was. If I had bought the shares for £5, say for example, my share price was £5 and it is now £12. If the company is buying back the shares, then whatever the excess is, company is paying me the dividends actually. For the company's from the company's perspective, it is considered as dividend. So company is paying me the dividend. If the company is paying me the dividend, of course I will have to pay the tax on that, and that will be income tax, and it will go into the dividends under the income tax pro forma. Right, so that will be income tax. So whenever the company is buying back its own shares, so we'll take the sales price, market price of that date. Then whatever the shareholder originally purchased it for, so original subscription price, we will deduct it out of that, and whatever the net amount is, that will be our net dividends, and we'll have to calculate the tax on that. That will be the income tax. Now we will also have to calculate capital gains tax under the income approach. So there will be two taxes, one is income tax and another one is capital gains tax under the income approach. So for the capital gains tax purposes, we'll take the sales, and sales would be the original subscription price, which was the cost here. Right, so for the capital gains tax purposes, we'll take the original subscription price as sales, and then we will deduct the cost out of that. Now sometimes original subscription price could be, the cost which we have bought it for could be more than the original subscription price. So in that case, it would be a loss. So that would be our chargeable capital loss, and otherwise it would be a chargeable gain if the sales, which means original subscription price, is more than what the cost was. Right? So it could be the capital gain or the capital loss. That is our income approach. Now if we come to the capital approach, sometimes the capital approach applies as well. If the capital approach applies, we will simply calculate the capital gains tax, and we will calculate whatever the chargeable gain is, we will calculate the capital gains tax at whatever the rate is. All right? And if the entrepreneur relief applies, we will calculate at the rate of 10%, otherwise 10 or 20% depending on the band. And depending on the residential property as well, in that case as well, there will be different rates. Anyways, so if the capital approach applies, then we will take the sales and we will deduct the cost out of that. Sales in this case as well would be the market price. And whatever the cost was, it will be either the capital gain or the capital loss, and we will calculate the capital gains tax at the rate which would be applied in that case. All right. Now capital treatment will only apply if certain conditions are satisfied. And if the capital approach applies, then we will only have to calculate the capital gains tax. We will not be calculating income tax, because that was income approach. That's why we were calculating the income tax. In capital approach, we will only calculate the capital gains tax. Now if you could open up your lecture notes please, and move to page number 85 Just be a minute, let me see. 86 of your lecture notes, sorry. Page number 86 of your lecture notes, please. And let me share the question with you as well through the screen share option. Yeah, question number, page number 86 of your lecture notes, P6 lecture notes. That's our company buys back its own shares. Now, first of all, it says income treatment, which I have listed down here on the left side on the board. So if a company buys its own shares for more than the original subscription, more than the amount originally subscribed, general tax rule says that there will be a distribution of the excess. The recipient of such distribution are treated in the same way as the recipient of the ordinary dividend for the income tax purposes. The shareholder will also have to pay capital gains tax on the shares sold to the company. So in this case, the sales proceed will be the original value, original subscription price of the shares, right? So I've told you both things, that we will calculate capital gains tax, we will calculate income tax as well. So whatever the excess of sales price is over its original subscription price, that will be considered as dividend, and individual will have to pay capital gains tax. Individual will have to pay individual will have to pay income tax on that, and they will also have to pay capital gains tax. And for the capital gains tax purposes, the original subscription price would be the sales, and after deduction of the cost, it will be either the capital gain or the capital loss. So that would be our income treatment. Now, normally income treatment would apply unless there are certain conditions satisfied, then a capital treatment would apply. So what are the conditions for a capital treatment to apply? However, capital gains tax disposal automatically occurs rather than an income distribution when an unquoted trading company buys back its own shares in order to benefit its trade, and certain other conditions are satisfied as well. Alright, so in this case, unquoted trading company is buying back its own shares in order to benefit its trade. So we'll have to see how would they benefit its trade, and certain other conditions are satisfied as well. First of all, let's see benefit to trade test. What is the benefit? How would we determine if it is benefiting the trade? If the dissident and disruptive shareholder is bought out, says there are sometimes shareholders which are never happy. Whatever you do, they will be still, they won't be happy. So they will be complaining. They will be, they will be disrupting the operations and all that, right? So if you just buy back the shares from the disruptive shareholder, it is always better for the company, and we know that it is benefit to the trade. Likewise, the second says the proprietor wishes to retire to make way for new management. Now, if the proprietor wants to sell the shares so that the new management can come, in that case as well. An outside investor who provided equity wishes to withdraw his investment, and a shareholder dies and his personal representative do not wish to retain his shares, in that case as well. Right, after that it says that the conditions to be satisfied by the vendor shareholder are as follows. So what are the other conditions for the shareholder? So the one who bought the shares, there are certain conditions which he must fulfill. So what are them conditions? So it says that they must be resident and ordinary resident in the UK when the purchase was made. So the shareholder who is selling the shares, of whom the company is buying the shares, so they must be resident and ordinary resident in the UK. The shares must have been owned by the vendor or her spouse throughout the 5 years preceding the purchase. So the shares must have been owned for 5 years. If one of the spouse dies, the ownership period is reduced to 3 years instead of 5 years. Alright, say for example, if a husband had purchased the shares 3 years ago and the wife died now, then the ownership period is 3 years. In this case, it's not 5 years, normal 5 years. Then it says the vendor and his spouse must be, as a result of the purchase, have their interest in the company share capital reduced to 75% or less of their interest before the disposal. Now, whenever we have shares in the company, we have to determine that how much is our percentage in the company. Now, the question will tell us that we have bought, say for example, 100,000 shares. Now, we bought 100,000 shares and the total shareholder of the company was 1 million shares. Now, if we have bought 100,000 shares and total company share was 1 million shares, in that case we will our ownership in that company is 10%, right? So our ownership in that company would be 10% if we hold 100,000 shares out of 1 million shares, right? So we will, first step would be to determine this amount, this figure. Now the second step would be that the condition would be satisfied if our ownership in that company is reduced to 75% of what it was before. Now say for example, if my shareholding in the company was 30% before I sold the shares to the company, because I was a disruptive shareholder, so the company said I want to buy back the shares. Now if the company is buying back the shares of me, I had 3,000 shares out of total 10,000 shares, so my shareholding was 30% in the company. Now current shareholding is 30%. Now my shareholding must be reduced to 75% or less. So we'll take 30% times 75%. So whatever the percentage is, my percentage should be that much after company buys the shares from me, right? So please understand this rule clearly, that whatever my percentage is before company bought the shares from me, how much is my holding in that company? Say for example, if it is 30%, then in order for this condition to apply, my percentage in the company after the company buys back the shares, my percentage should be 75% of what it was before the purchase, right? I hope you got it. So how would we determine? We will take the percentage before the company buys back the shares, say for example 30%, multiply by 75%, so that much, so my percentage in the company should be that much or less than that, which would be 75% or less than that, right? So read this rule again please. It says the vendor and his spouse must be, as a result of the purchase, have their interest in the company's share capital reduced to 75% or less of their interest before the disposal. All right, so our shareholding must be reduced to below 75% or 75%. Then finally it says that vendor shareholder must must not hold more than 30% of the ordinary share capital. Right, so the vendor must not hold 30% in the company. Now if the vendors hold 30%, then this condition will not apply as well. Now after that, I say the capital gains tax disposal also occurs when a company purchases shares to enable the vendor to pay inheritance tax arising on death. Now sometimes company buys back the shares from the individual because they want to pay inheritance tax. In that case, the capital treatment would apply, and this benefit to trade, and the other condition does not need to be applied in that case. So the capital treatment would apply simply see this reduction in the share capital and these conditions and benefit to trade test. Then in that case, these conditions does not need to be applied. All right, so there are two difficult things in this one. The reduction must be to 75% of what it was before that, and other one is the shareholding must not be 30% in the company. All right, so this 30% is when we have when the company had bought the shares from us. Right, so it is after the company had bought the shares from us. It must be it must not be more than 30%. Right then, so if you could open your BPP exam kit, please. Let's do a question which is relevant to this. Let's do a question then, please, which is relevant to this question, which is relevant to this topic. Sorry. Now, if you could open your BPP exam kit, is question number 27 of BPP exam kit. It was examined in March 2016. Right, March 2016, and we are going to do part A of this question, part A1 and part A2. Now first of all, it's part A1. If you read the requirement, it says let me read the question name again. If you have any other exam kit, it's Maria and Granada Limited, and it was examined in March 2016. So if you have any other exam kit, please open up this question. It was examined in March 2016. Right, so if we read the requirement A1 first, it says explain with the aid of calculations why the capital treatment will not apply if Maria sells 2,700 of her shares back to the Granada PLC, but will apply if alternatively she sells back 3,200 shares. So in the case if she sells 2,700 shares to the company, the capital treatment would not apply, and the capital treatment would apply if Maria sells 3,200 shares to the company. So we'll have to see that how much is her actual shareholding, then we can determine that why the capital treatment would apply or would not apply. Now, if we read the requirement, if we read the scenario of the question, it says your firm has been asked to provide advice to Granada Limited and one of its shareholders, Maria. Maria wants advice on the tax consequences of selling some of her shares back to the Granada Limited. Granada Limited wants advice on the corporation tax and value tax implications of recent acquisition of an unincorporated business. So first of all, the information about Maria is given. So Maria is resident and domiciled in the UK, is a high rate taxpayer and remains so in the future, has dividend income of £6,000 in the tax year 18-19. So she already got dividends of £6,000 in the current tax year. Has already realized chargeable gains of £15,000 in the tax year 18-19, which tells me she has already used the annual exemption for our current tax year, and she has already used our the nil rate ban of dividends as well. And then it says shares in Granada Limited. Maria subscribed for 10,000 £1 ordinary shares £1 ordinary shares in Granada Limited at par value in June 2009. So what would be the par value? It is given, it's £1, all right? So par value is £1. Now Maria subscribed for 10,000 shares, which are £1 ordinary shares in Granada Limited at par in June 2009. So the shares were bought in 2009. Maria is one of 4 equal shareholders and director of the Granada Limited. Now 4 equal shareholders, which means her shareholding would be 25% in the company, because if she holds 10%, other 3 shareholders also hold 10%. Total shareholding in this company would be 40,000 shares, of which she holds 10,000 shares. Our current shareholding in this company is 25%. Right? And then it says Maria intends to sell either 2,700 or 3,200 shares back to the company on 31st of March 2019 at their current market value of £12.80 per share. Then it says all of the conditions of capital treatment are satisfied except for potentially the condition relating to the reduction in the level of shareholding. Now we have to see, it says that capital treatment conditions are, all of them are satisfied except for the one reduction in the share capital, right? So we'll have to see that if this condition applies or not on 2,700 shares and on 3,200 shares. All right. Now say for example, if let me do this question on the board. Now say for example, if she hold if she sells 2,700 shares back to the company. Now please remember the shareholding, total shareholding in the company was 40,000 shares. Total shares in the company was 40,000 shares. Now whenever the company is buying back its own shares, whatever the number of shares which the company is buying back, that will be cancelled out, so that will be deducted out of the total shareholders. Say for example, if the company had total shares of 40,000 in this case, and if the company is buying back 2,000 shares, say for example, then the total shareholding after buying back would be 38,000, not 40,000 pounds. Please remember that. So whenever the company is buying back its own shares, that shareholding will be cancelled, because the company cannot pay the dividend to themselves. So them shareholders are with the company, so them shares are with the company's own pocket, so they will be cancelled. So the total shareholding in that case would be whatever the total shares were before, and we will deduct the amount of shares which we have bought back from the shareholders, right? So in this case, the total shareholders of the company were 40,000 shares. Now when the company buy back the shares, which are 2,700 shares in this case, so 40,000 less 2,700, that would be the total shareholding after the company bought back the shares. All right. Now her current shareholding, if we see, so her current shareholding in the company, let me see. So if is the buys back at 2,700 shares. Now the company buys back 2,700 shares. Now the shareholding, current shareholding is 10,000 shares in the company. 10,000 shares in the company, and total shares in the company are 40,000. So which means her shareholding is 25%, right? That is her current shareholding. So what was the rule? What were the conditions? That this shareholding must be reduced to 75% or less than that. So her shareholding would be that. So we'll take 25% times 75% of that. So let's see it on the calculator. 18.75%. So that is her shareholding. That should be her shareholding, a maximum, after the company buys back the shares, right? So we'll take the current shareholding. Her shareholding must be reduced to 75% or less than that, which is 18.75%. So shareholding must be reduced to 18.75% or less than that. Then this condition would apply. Now we'll have to see that how much is her actual shareholding after the company buys back 2,700 shareholders, as 2,700 shares. So her current shareholding is 10,000 shares. 10,000 less 2,700. So that would be how much? 6,300. If I'm not wrong, 6,007. No, 7,300. So that would be 7,300. And the total shares in the company are 40,000 shares less 2,700 shares. So that would be how much? 37,300. So if we divide that, it's 7,300 times 37,300. So whatever the shareholding is, that is her shareholding after the company buys back the shares. Because the company's shares will also be reduced, because as I said, the company, whatever the number of shares the company is buying back, them shares will be cancelled out. So we'll take 7,300 shares, 7,300 divided by 37,300 divided by 37,300. So her share divided by 37,300. So her current shareholding is 19.57. Alright, so that is 19.57, which means that it is not reduced to 18.75%, it is more than 18.75%. Hence the capital treatment would not apply when she buys back the 2,700 shares. Now let's see if the company buys back 3,200 shares. Now if the company buys back 3,200 shares, so in this case it would be buys back 3,200 shares. If the company buys back 3,200 shares, so in that case it would be, current shareholding is 25%, so it must be reduced to 18.75%. So it would be 10,000 is current shareholding less 3,200 shares the company is buying back, so that would be 6,200 shares, and it would be divided by total shareholding is 40,000 shares. If we take 3,200 out of that, that would be 36,800, 36,800 I think, and that would be 800 as well I think. 6,800, yep. So 6,800 divided by 36,800. So let's see what is the percentage in this case, because this time the company is buying back 3,200 shares. So 6,800 divided by 36,800 times 100. So that is 18.47. 18.47%, now which is less than 18.75. So in this case the capital treatment would apply. Capital treatment would apply in this case. So because it is reduced to less than 75%, and it is less than 30% as well, right? Now that's part A done. Now if you come to part B of the same question, if you open the same question please, part A2, part A2 of the same question. It says calculate Maria's after tax proceeds per share if the shares, if she sells 2,700 shares back to the Granada Limited, and alternatively if she sells 3,200 shares back to the Granada Limited. Now if she sells 2,700 shares, we know that the income approach will apply. If she sells 2,700 shares, income approach will apply. So in this case, because she's selling 2,700 shares, the company is buying 2,700 shares. Now we'll have to see what is the share price. We'll take sales proceeds, which will be the market value. Now let me see on the question what was the market value. So market value in this case was £12.80. So market value in this case was £12.80, and we will deduct the original subscription price, which in this case was £1, and the amount is how much? £11.80. That is the amount which is the net dividend on which she will have to pay tax. Now on 1180, because the nil rate band, dividend nil rate band has already been used anyway, so the rest of the amount, and she is also the higher rate taxpayer, it was told us in the question, so she will have to pay tax on the 32.5% on that. 32.5% tax on that will be paid. So whatever the tax is, let me see it on the calculator. £11.80 times 32.5%, so that is £3.83, right? So that is our £3.83. That is our tax on the dividends under the income approach. Now let's see what was actually required in the question. Was he asking about the tax liability or what? Now if we look at the question, what he's asking actually, let me see. Now he's asking in the question, calculate Maria's after-tax proceeds. So he's asking after-tax proceeds. We know the sales proceeds was £12.80. So we'll take £12.80 less tax, because he's asking after-tax proceeds. So we'll have to deduct the tax out of that. So £3.83 is the tax. So whatever the amount is, net amount, £12.80 less £3.83. So the net amount is after-tax proceeds. If the income approach applies, if she sells 2,700 shares, so the income tax will apply. Now she does not only have to pay the income tax, she will also have to pay the capital gains tax. Now if we see the capital gains tax, there won't be any treatment for the capital gains tax in this case, because we take the sales, which will be the original subscription price, which in this case is £1. So if we take £1, and the cost in this case is £1 as well. So the net figure is net, no gain, no pain. So there won't be any capital gains treatment. So the only treatment would be the income tax, which you will have to pay. And after tax proceeds are £12.80 is the sales proceeds less £3.83 is the tax. So whatever the net amount is, that is our after tax proceeds. And we have done this thing with the help of this formula, which I have listed down when we started the lecture. That is our income approach. Right now it says what would be the after tax sales proceeds if the company buys back 3,200 shares. Now we know in this case the capital gains tax treatment would apply, and we'll take sales, which is the original subscription price. Now sales in this case is original subscription price, and that is our income approach. And we will do the capital approach, So the sales would be the market price. So we'll take the sales, which is the market price of £12, how much? £12.80, and we will deduct the cost out of that, and the cost in this case is £1, so that would be £11.80, and the annual exemption is already been used, and also the annual exemption is being used, and there isn't anything else to deduct out of that. So this £11.80 is our chargeable gain, and we will have to pay capital gains tax on that. Now read the question and tell me if any relief applies in this case or not. Chargeable gain. Now because there were only 4 shareholders in this case, and Maria held more than 5% shareholding in the company, it tells us in the question Maria holds a 25% shareholding, and after that her shareholding is still more than 5%, because her shareholding in this case is how much? Her shareholding in this case was 18.47, so it is more than 5%, and she is directed in the company as well. So it is just giving me a hint of entrepreneur's relief. So in this case, the entrepreneur relief would be available, which tells me that the capital gains tax rate would be 10% on that. So the chargeable gain in this case is 1180. On that, there will be 10% capital gains tax. So take 10% of that, In this case it would be how much? I think it would be £1 something. So that is chargeable gain. So if we deduct the capital gains tax at 10%, because the entrepreneur relief is available, ER, I would write it down. So whatever the capital gains tax is, that would be deducted out of that, and that would be that is the chargeable gain. On that we will deduct the tax, and that would be the net amount of the gain after tax. But in this question we are asked that how much would be the after tax proceeds. So we will take £12.80, that is the sales proceeds, and we will have to deduct the tax out of that. So whatever the tax is, in this case 10% of 1180, so we'll deduct that amount out of this one, and that is our after tax proceeds. Right, so please calculate this one. I think it would come in this section, sorry. Right, so we'll take 1280, which is the market price, sales proceeds less the tax which we have paid, which would be 10% on that, and that would be our after tax sales proceeds. Right. If you want to note down everything I've written on the board, please make sure you do that now. Now, as far as this rest of the question is concerned, please make sure you do the rest of the question as well. One is about patent, and one is about trading losses, and then value-added tax. So if you're comfortable with the rest of this question, you can do that as well. So that's it for this video lecture. That's it for this video lecture. Now the next chapter, if we look at it, is about overseas matters for the companies. Now I won't be recording the next video lecture for overseas aspects of the companies, because it is exactly the same which I have recorded last year for the Finance Act 16. So I will get it installed on the website page, so you will find the lecture which was recorded in the previous year. All right, so that is still relevant, apart from a few minor changes about the tax rates. So I won't be recording the next video lecture. You will have to watch the lecture which was recorded in the last year. That is still relevant, but you just have to be careful about the tax rates. So for our current tax year, corporation tax rate is 19%. In the previous year it was 20%. All right, so that is the only minor difference. And we will be doing one question as well in the next video lecture, which was recorded in the last year. All right, so and while doing the question, you must open your current PPP exam kit. And when I said please open that question last year, I said that last year, that please open up that question, then you must use your current exam kit to open that question, because in the current exam kit there will be little different tax rates. All right, so I hope that you can manage at this level. There is only one video lecture which is not being recorded in this year. All right, apart from that minor 19%, 20%, everything else is the same. And the exam kit last year, which I used to solve that question, there was a percentage which was relevant that time. So you must use your current exam kit while watching that lecture. That's my exam tip. And you must also keep the current notes as well in front of you while watching that video lecture. Apart from that, we are finished with our corporation tax, and we will move to our value-added tax in our next video, and then see how does the value-added tax works. All right, and I will also for the corporation tax purposes, your homework is to do all the questions which we have done in our videos, and on top of that you will also have to solve the questions which will be listed on exam tips video, which will be uploaded at the end of our syllabus. I will see you in the next video lecture, and we will look at value tax. Goodbye.